Question 811. A real estate license applicant whose name is on the state's list for delinquent child support can A. Receive a temporary 150-day license, B. Receive a temporary 1-month license, C. Receive a license at the discretion of the real estate commissioner, D. Never receive a license, their non-payment disqualifies them in perpetuity. Correct answer is A. Receive a temporary 150-day license. In California, if a real estate license applicant's name appears on the state's list for delinquent child support, they are not immediately disqualified permanently. Instead, the Department of Real Estate, DRE, will issue a temporary 150-day license to an otherwise qualified applicant. During this 150-day period, the applicant must work with the Department of Child Support Services, DCSS, to get a release. If a release is not provided to the DRE within those 150 days, the full-term license will not be issued, or an existing license will be suspended. Question 812. An escrow agent is empowered to A. Alter the escrow terms when asked to do so by one of the parties, B. Determine which financing offers the best terms to the buyer, C. Select which security system to be installed at the property, D. Call for the loan to be funded by the purchaser. Correct answer is D. Call for the loan to be funded by the purchaser. An escrow agent acts as a neutral third party in a real estate transaction. Their primary role is to ensure that all conditions of the purchase agreement and escrow instructions are met before the transfer of funds and title occurs. They operate strictly according to the written instructions provided by the buyer and seller. One of the critical roles of the escrow agent is to manage the flow of funds and documents. When all closing conditions are met, the escrow officer will request the necessary funds. This call for funds goes to the buyer's lender for the loan amount, and directly to the buyer for their down payment and closing costs. This ensures all money is in the escrow account for the final disbursements. They facilitate the funding process according to the instructions. An escrow agent is a neutral party and cannot unilaterally alter the escrow instructions or terms of the contract. All parties involved, the buyer, seller, and sometimes the lender, must agree to any changes in escrow terms. These revisions must then be given to the escrow holder in writing. This written document acts as an amendment to the initial instructions. That is the role of mortgage brokers, lenders, and real estate agents, for general advice, or attorneys, for legal advice. The escrow agent's job is to follow the instructions regarding the financing that the buyer has already secured. Decisions about property improvements or fixtures are made by the buyer, possibly with advice from their real estate agent or inspector, but not by the neutral escrow agent. Question 813. A joint tenant is legally able to A. Lease their interest, B. Sell their interest, C. Encumber their interest as security for a mortgage loan, D. All of the above. Correct answer is D. All of the above. A defining characteristic of joint tenancy is the 4 unities: time, title, interest, and possession, and the right of survivorship. This right means that upon the death of one joint tenant, their interest automatically passes to the surviving joint tenants, bypassing probate. However, a joint tenant can take actions during their lifetime that can sever the joint tenancy and convert it into a tenancy in common, which does not have the right of survivorship. A joint tenant can lease their interest in the property. However, a lease generally does not sever the joint tenancy in California. The leasehold interest would terminate upon the death of the lesser joint tenant, and the surviving joint tenants would take the entire property unencumbered by the lease. A joint tenant can sell their interest in the property without the consent of the other joint tenants. If a joint tenant sells their interest to a third party, it severs the joint tenancy as to that selling tenant. The new owner becomes a tenant in common with the remaining joint tenants, who continue to hold their interests as joint tenants with each other. A joint tenant can encumber their interest, e.g., place a mortgage or deed of trust, on their share of the property. In California, a mortgage or deed of trust placed by one joint tenant does not sever the joint tenancy unless and until the mortgage is foreclosed upon and the property is sold during the lifetime of the debtor joint tenant. If the debtor joint tenant dies before the foreclosure sale, the lien typically extinguishes because their interest automatically passes to the surviving joint tenants, free of that lien. Since a joint tenant can sell, lease, and encumber their interest, even though the effect on the joint tenancy varies, selling severs, leasing and encumbering typically do not unless a foreclosure sale occurs. All of these actions are legally permissible for an individual joint tenant. Question 814. Junior loans are usually secured from A. Insurance companies, B. Private lenders, C. FHA, D. Commercial banks. Correct answer is B. Private lenders. Junior loans, or second mortgages, third mortgages, etc., carry a higher risk for lenders because in the event of a foreclosure, they are paid only after the senior, first loan is fully satisfied. Due to this increased risk, junior loans are often obtained from sources willing to take on that risk, typically at higher interest rates. Insurance companies are major players in the mortgage market, primarily investing in large, stable, and less risky ventures. They often focus on commercial real estate or act as investors in first lien mortgage-backed securities. They are less common direct originators of higher-risk junior residential loans. The Federal Housing Administration, FHA, insures primary mortgages, first liens, to make homeownership more accessible, especially for low to moderate income borrowers. They typically do not originate or insure standalone junior liens like private lenders. However, FHA loans can sometimes be paired with down payment assistance programs, often structured as junior liens, from state or local agencies such as CalFA in California. Commercial banks certainly originate mortgages, including home equity loans and lines of credit, HELOCs, which are junior liens. However, they typically have stricter underwriting standards than private lenders. They are often less willing to take on the higher risks associated with many junior loans, especially those lacking substantial equity or strong borrower credit. Private lenders, including individuals, mortgage funds, and hard money lenders, are a very common source for junior loans. They are more flexible, can often close deals quickly, and are willing to take on higher risk in exchange for higher interest rates and fees. Many junior loans, especially those for short-term financing or for borrowers who don't qualify for traditional loans, come from this sector. Seller financing can also be a form of private junior lending. Given the common characteristics of junior loans, higher risk, often higher interest rates, more flexible terms, private lenders are a very significant source. Question 815. Private restrictions imposed on property can be conveyed by A. Contract, B. Deed, C. General plan descriptions, D. All of the above. Correct answer is D. All of the above. Private restrictions, like CC&R's covenants, conditions, and restrictions, are indeed limitations on property use established by private parties. The fundamental agreement that creates these restrictions is a contract. Developers enter into contracts when planning and selling properties in a subdivision, and these contracts often include the terms of the restrictions. Subsequent buyers implicitly or explicitly agree to these by purchasing within the restricted community. Deed is a primary method. The individual deeds for lots within a subdivision will either contain the full text of the restrictions or, more commonly, reference a previously recorded master document, like a declaration of restrictions. By accepting the deed, the grantee, buyer, becomes bound by these restrictions. In the context of a new subdivision, the developer records a comprehensive document, often titled a Declaration of Covenants, Conditions, and Restrictions, sometimes referred to as part of the General Plan Restrictions, in the context of the entire subdivision development scheme. This master document is recorded in the public records and sets out all the rules for the entire subdivision. Even though it's a private document, not a government, general plan, it functions as a foundational set of restrictions that applies to all lots. When individual lots are then sold, their deeds will reference this recorded declaration. Question 816. Sam conveys a life estate to his son, John, for the life of his other son, David. John marries Sandy, then John dies a year later. The estate goes to A. Sandy, John's wife, because she is the heir of the life estate holder. B. Sam, John's father, because the person to whom he conveyed the estate has died. C. David, John's other son, because he is the measuring life for the life estate. D. Because a death has occurred, a judge in probate court must decide. Correct answer is A. Sandy, John's wife, because she is the heir of the life estate holder. Grantor, Sam. Life tenant, John, the person who holds the life estate. Measuring life, or pure autre vie, David, the life by which the duration of the estate is measured. The crucial element here is that the life estate is for the life of his other son, David. This means the estate's duration is tied to David's lifespan, not John's. John marries Sandy. This is a personal event and doesn't change the nature or duration of the life estate. John dies a year later. Since John is the life tenant, but David is the measuring life, the life estate does not terminate upon John's death. The estate continues as long as David is alive. Since the life estate is still in effect, because David is still alive, John's interest in the life estate will pass to his heirs. This type of life estate, pure autre vie, is inheritable by the life tenant's heirs if the life tenant dies before the measuring life. When John dies, his interest in the life estate, which is for David's life, passes to his heirs, which in this case would be his wife, Sandy, as a primary heir. She will hold the life estate for the remainder of David's life. Sam, the grantor, only gets the property back, or it goes to a designated remainderman, once David, the measuring life, dies. John's death does not revert the estate to Sam. David is merely the measuring stick for the duration of the estate. He doesn't automatically receive the estate upon John's death. While probate might be involved in distributing John's estate, including his interest in the life estate, the rule of law dictates who inherits the life estate, not a discretionary decision by a judge. The judge would apply the law of wills, intestate succession to determine John's heir to the life estate. Therefore, the estate goes to John's heir, Sandy, to hold for the remainder of David's life. Question 817. The penalty for paying off a Calvet loan in less than 3 years is A. $500. B. 4 months worth of interest. C. 1% of the loan amount. D. None of the above. Correct answer is D. None of the above. Calvet loans, offered by the California Department of Veterans Affairs, are known for their favorable terms and benefits for eligible veterans. One significant benefit consistently highlighted in their program information is the absence of prepayment penalties. According to Calvet's official website and other resources, there is no prepayment penalty fee for paying off a Calvet home loan early. Question 818. Which of the following would be considered non-recurring closing costs in the sale of a property? A. Title insurance. B. Appraisal. C. Natural hazard disclosure. D. All of the above. Correct answer is D. All of the above. In real estate, closing costs are typically categorized as either recurring or non-recurring. Non-recurring closing costs are one-time fees and expenses paid at closing that are associated with the transaction itself and will not be paid again. Recurring closing costs are ongoing expenses that begin at closing and continue to be paid periodically, e.g., monthly, annually, such as property taxes, homeowners insurance premiums, and WA dues. Title insurance is a single premium paid at closing. It protects the buyer, owner's policy, or the lender, lender's policy, from future claims. These claims usually stem from title defects that existed before the property's ownership transferred. It is a non-recurring cost. The appraisal fee is paid once to determine the market value of the property for the lender's purposes. It is a non-recurring cost. Natural Hazard Disclosure Report, required in California, discloses if a property is in certain natural hazard zones, e.g., earthquake fault zones, flood zones. The fee for this report is paid once at closing. It is a non-recurring cost. Question 819. The release clause in a trust deed is used to release a. Some properties upon partial payment, if more than one property is used as security for the debt. B. The escrow company from liability. C. The borrower from liability. D. The seller from liability. Correct answer is A. Some properties upon partial payment, if more than one property is used as security for the debt. A. Release clause, in a trust deed, or mortgage, is a provision that allows specific portions of the collateral to be freed from the lien of the trust deed under certain conditions. The most common context for release clause is in a blanket mortgage or trust deed, which covers multiple properties, e.g., in a subdivision. When a developer sells individual lots, the release clause allows a portion of the loan to be paid. This action then frees that specific property from the overall lien. This way, the new buyer gets a clear title. The release clause in a trust deed deals with the collateral for the loan, not the liability of an escrow company. Paying off a full loan frees the borrower from all liability for that debt. In contrast, a release clause only allows specific collateral to be released after a partial payment. It doesn't eliminate the borrower's overall liability for the remaining loan balance. The borrower remains liable for the remaining balance on the properties still covered by the lien. Question 820. Sam, a California real estate broker, has a prospective purchaser referred to him by a broker from Nevada. After a sale to that buyer is transacted, Sam wants to split his commission with the Nevada broker. According to the real estate law, Sam may A. Not split a commission with an out-of-state broker, B. Split a commission with an out-of-state broker, but only if the sale occurred within 1 month after the client referral occurred. C. Split a commission with the out-of-state broker, D. Split a commission with an out-of-state broker, if Sam, the California broker, retains 2/3 of the proceeds. Correct answer is C. Split a commission with the out-of-state broker. Under California real estate law, a California licensed real estate broker is allowed to split a commission with an out-of-state broker. The key condition for this is that the out-of-state broker must not perform any acts requiring a real estate license within California. The Nevada broker is allowed to refer a client to Sam. However, all activities requiring a real estate license for the California sale must be performed solely by Sam, the California licensed broker. This includes tasks such as showing properties, negotiating terms, or preparing transaction documents. California Business and Professions Code Section 10137 allows a California broker to share commissions with out-of-state brokers. This is permissible as long as the out-of-state broker did not perform any licensed real estate activities within California.